Secrets to understanding and investing in real estate investment trusts, REITs. Why are REITs the best option for real estate investors? Understanding REIT wrapping is the key to profiting from real estate's strong returns without purchasing even one brick-and-mortar property. The future of real estate investment may be in REITs, but only if you know how to choose the right one. It would help if you bought REITs for their consistency, stability, and income. Investors can buy shares of these investment vehicles through ordinary brokerage accounts. That means no minimum investment, load fees, and little information overload. Now is the time to invest in real estate investment trusts. Welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss the beginner's guide for REIT investing. So let's get started. What is a REIT? The Real Estate Investment Trust is more commonly referred to as a REIT. That business focuses primarily on making investments in various tangible estate-related assets. Individual investors can purchase shares of the corporation. This provides them with convenient access to the real estate market. Most REITs are traded on public stock markets. However, some are traded privately. The ability to convert quickly into cash is a significant benefit of publicly traded REITs. Generating income from real estate holdings is a real estate investment trust (REIT) objective. This income originates from a variety of different sources. Why were REITs created? The Real Estate Investment Trust (REIT) was established in 1960 during the Eisenhower administration in the United States by the Cigar Excise Tax Extension Act to make investing in diversified portfolios of income-producing real estate more accessible and affordable for everyday investors. These vehicles were developed. Since ownership is organized according to a share-based notion, it is analogous to how a mutual fund issues shares and pools together different investments in one place. Real Estate Investment Trust (REITs) must follow specific guidelines regarding their internal operations to be recognized as REITs. This is only one of the many features that sets real estate investment trusts apart from other investing options. By law, REITs must invest at least 75% of their total assets in real estate. They must get at least 75% of their gross revenue from authentic estate-related sources, making this a defining characteristic of REITs as opposed to other investment vehicles. To ensure that real estate investment trust REITs can achieve the high requirements to be classified as a law also requires REITs to distribute at least 90% of the profits from their real estate holdings to their investors. The funds from operations (FFO) metric are frequently among the most helpful when comparing the efficiency of various REITs. Incorporating real estate assets into a traditional stock and bond portfolio may be advantageous for various reasons. Real estate investments can generate long-term profits and consistent dividends if their value rises over time. Real estate investments also give another layer of diversification to an investor's overall portfolio. One alternative way to invest in real estate that is easy to understand and risk-free is through real estate investment trusts. The requirement to maintain high levels of operation is a contributing factor. On the other hand, as we'll see in the following section, not every REIT is created equal. The investment strategy and how a REIT is traded can significantly impact many of the trust's characteristics, including its earnings potential and diversification options. How to invest in REITs. Real estate investment trusts are structured similarly to the mutual funds with which most investors are already acquainted. The relevant REIT then utilizes the money that is paid for shares to make investments in the assets that they have chosen. While the investors are putting money into the REIT is debating what to do with the money that has been contributed. Most crucially, real estate investment trusts allow investors to profit from the historically strong real estate market without needing to take out a loan. Gaining access to companies that invest in real estate through real estate investing is possible. It's important to refrain from generalizing, but all an investor needs to do to get started in the stock market is join up with a brokerage. Make sure they do their homework and invest intelligently. Investors are responsible for acknowledging this risk and knowing that a sufficient amount of education and information can help mitigate its impact. There is always a degree of danger associated with an investment, and real estate investment trusts are no exception. A carefully crafted investing strategy has the potential to bring in substantial gains over several years. Types of REITs. These are companies in the real estate industry that own residential or commercial properties and manage such assets on behalf of investors. These REITs allow private investors to purchase shares of the REIT on public stock exchanges. As an investor, you can select from several REITs, each of which invests in a specific sort of real estate. There are some common choices that you might come across. Residential REIT. Residential real estate investment trusts primarily focus on residential properties. They own the properties and collect rent from tenants to generate income. Single-family homes, apartment complexes, prefabricated homes, and even dorms for college students might be included in this real estate category. They may also choose to concentrate their investments in areas that provide the most promising chances, or diversify their real estate holdings over some different communities. Office REIT. Office REITs are real estate investment trusts that own buildings mostly comprised of commercial office space. They generate cash through the leasing of this office space to various tenants. These real estate investment trusts typically own a variety of office spaces, ranging from substantial office buildings such as skyscrapers to tiny office parks in suburban locations. They may center on a particular category under this kind of real estate. Others may concentrate on providing office space that is geared for a specific kind of tenant. Retail REIT. These are companies in the real estate industry that own residential or commercial properties and manage such assets on behalf of investors. These REITs allow private investors to purchase shares of the REIT on public stock exchanges. As an investor, you can select from several REITs, each of which invests in a particular sort of real estate. Mortgage REIT. Borrowing money via a mortgage REIT, commonly known as an MREIT, is a particular financial product from those listed above. Mortgage-backed REITs are an alternative to typical real estate investment trusts, which invest in purchasing and selling actual properties. Many house purchases are made feasible by taking out mortgages. REITs can originate mortgages, or corporations can buy mortgage-backed securities. Mortgage holders must pay back the REIT any principal and interest accrued on their loans. Healthcare REIT. Buildings that are utilized in the healthcare industry are what medical real estate investment trusts purchase and then lease out to tenants. Establishments such as clinics, doctors' offices, assisted living communities, nursing homes, and other establishments of a similar nature can fall under this category. Because of the unique requirements of the people who rent these buildings, the possibility of making a profit from investing in real estate could be more frequent. What are the requirements needed to work for a REIT? REITs are distinguished from other stocks traded on Wall Street by some criteria. Most of a real estate investment trust's assets need to be related to real estate investments for the trust to qualify as a REIT. In contrast to its traditional real estate equivalents, real estate investment trusts are required by law to distribute at least 90% of their taxable income to shareholders yearly in the form of dividends. As a result of their obligation to pay dividends, real estate investment trusts have a constrained capacity for expansion. Nonetheless, there are advantages to be gained from redistributing profits in and of them. REITs that meet specific requirements can deduct from their annual corporate taxable income the total dividends they provide to their shareholders. Their taxable obligations are significantly reduced as a result of this. Are REITs good long-term investments? Although real estate investment trusts are only sometimes considered suitable long-term investments, they can be. Real estate investment trusts pay dividends to keep their shareholders happy, but the most attractive stocks for long-term investments are those that have had significant growth over many years. According to federal law, a real estate investment trust must pay out dividends to its investors equal to at least 90% of its taxable revenue. By adopting this decision, there is a significant risk that any company currently categorized as a REIT would have its potential for expansion severely limited. In exchange for the opportunity to pay dividends to their investors, real estate investment trusts, also known as REITs, are excused from paying the corporate taxes typically levied against businesses. That is not to say that real estate investment trusts do not have the potential for enormous growth. Instead, the accumulation of dividends is the most compelling feature of keeping on to REITs for the long haul. Any shareholder who owns shares in a real estate investment trust will receive a dividend payment. This payment will be issued quarterly. The expected frequency of dividend distributions made by real estate investment trusts is 4 times per year. The dividend payout schedule of a REIT is entirely up to the management of the REIT and is also dependent on the health of the business that the REIT is investing in. Not only REITs, but investment shares in general have the potential to be dividend payers. Several of the stocks included in the S&P 500 pay out dividends to their shareholders. However, the dividends distributed by REITs are typically more significant in size and more frequently distributed than those distributed by stocks. Because the Internal Revenue Service, IRS, considers dividends paid to investors to be taxable forms of income, the term income investor is widely used to refer to those who invest in real estate investment trusts. There is no reason why today's most excellent REIT portfolios couldn't create enough passive income to cover an annual wage. That's why they call it income investing. All you need is a sizable holding in several high-quality REITs. Taking a look at the credit ratings of the REIT might also provide you some insight into the level of risk. Investment-grade credit ratings are what you want to see. In the end, you should choose quality and sustainability when it comes to investments in REITs over the long run. Rules for REITs. In 1960, the United States saw the birth of real estate investment trusts designed to enable private investors to profit from commercial real estate without acquiring the properties themselves. In the United States, the rules were established by sections in the Internal Revenue Code. To be considered a REIT, a corporation must have at least 75% of its total assets invested in real estate. In addition, at least 75% of the company's gross income must originate from authentic estate-related sources, such as rents or mortgage interest. Plus, the corporation must distribute as dividends to its shareholders at least 90% of the taxable income it generates each year. Because of these restrictions, real estate investment trusts are a trustworthy and reliable method for receiving a consistent flow of income. They also have the potential to experience long-term capital appreciation as a result of the growth in the value of the assets. How do investors get money back from REITs? Investors in real estate investment trusts are entitled to the same returns as the REITs, including income and appreciation. Typically, dividend distributions are the primary means investors in real estate investment trusts realize profits on their assets. These sums are the profits from various real estate investments. The REIT will typically make regular dividend payments to its investors. These payments will be determined by the percentage of the total fund that each investor owns. However, a shareholder of a REIT often needs to sell their shares to realize appreciation gains. In contrast to income, appreciation is usually realized by selling shares in a single lump sum payment. As a result of the proceeding, a REIT may distribute capital gain dividends to its shareholders upon the sale of an underlying property without requiring those shareholders to sell any of their REIT shares. Any such increase in the value of a stock holding, including REITs, is known as a capital gain for the investor. One of the key selling points of real estate investment trusts is that they can give returns in the form of appreciation and income. The two types of returns are not mutually exclusive either, and they could grow simultaneously. Unlike many other investment options, real estate is a physical asset with established value and inherent scarcity. When there is a rise in the market price for real estate, the rents that a given piece of property could fetch could rise in line with those prices. This is a significant factor in why real estate has consistently outperformed other asset classes. How do REITs help you save money on taxes? Investors in REITs can enjoy some additional and significant benefits, in addition to the standard tax benefits available to investors who choose to gain access to REITs through traditional tax-advantaged accounts. These advantages include the fundamental capability of a fund to be categorized as a REIT is essentially at the heart of the first and most well-known tax advantage associated with REITs. To be designated as an official REIT, one of the requirements that a fund must fulfill is to distribute at least 90% of its taxable income to its shareholders in the form of dividends on an annual basis. If a fund successfully meets the standards to qualify as a REIT, these earnings are exempt from taxation at the business level. Instead, earnings are distributed to investors and taxation is solely applied at the level of the individual investor. Because of this, the burden of double taxes that many investors endure when investing in traditional business stocks is eliminated. Investors can retain a more significant proportion of their overall returns because there is no tax levied at the corporate level. Again, if the real estate owned by a REIT is producing taxable income, the vast majority of the yields from that real estate will be distributed to investors within 1 year. Should you invest in a REIT? Long-term investors seeking additional ways to diversify their portfolios beyond stocks and bonds might consider purchasing shares in a real estate investment trust. You may have more success reaching your financial objectives if you invest a small amount of your portfolio in alternative assets, such as real estate. However, only some are good candidates for investing in real estate investment trusts. Investing in REITs will make an investor's investment strategy too complicated if they still need to build up a sizable portfolio. Instead, these investors might wish to examine alternative investment options, such as learning to invest in index funds, which might be a better fit for them. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.